Can you guys see my screen?
We can.
Okay, so it's this stuff over here. Hold on a minute. I got that thing in the white here. I don't know why. All right. Yeah, I'm not very tech savvy, so you gotta forgive me. Um, but anyway, you see my screen, so that's good. So let's get into it. Okay, we're here. Let's talk about it. Anybody else joins, they can jump in. So anyway, as I was saying, you guys, we have a small audience today, at least live audience. We have Mark and Steven, and we have me. So again, this is the second session in the 5-part series that I put together on how to help your business owner clients keep more of what they, more of what they build when they exit. And today we're going to look at really a very simple but critical idea. And that idea is the way a company is set up for tax purposes can significantly change how much the owner actually walks away with at closing. And as I said to you, Stephen, before we started here, my experience has been in practice that entity choice is often made very quickly when a business is formed. It's usually based on what's easy or what's expedient or what the tax preparer suggests. But very rarely is this choice initially done or even subsequently revisited with the eventual sale in mind. And so our focus today is not to make you tax experts. I just don't want to do that, nor do you want to. But to give you a clearer sense of when entity choice can create either a great planning opportunity or a painful surprise for your clients at exit. So let's start off this whole conversation. Let me see if you see what I see. Okay, good. Okay. So let's start off with the first concept. And the first thing I'd like to talk about here, and I'll put this on your radar screen, is something called qualified small business stock, also known as Section 1202 stock. And so as we'll see, in the right situation, if you're a C corporation and you qualify for this treatment, this qualified small business stock treatment, the rule can reduce and sometimes effectively eliminate federal income tax on your gain, on an owner's gain when they sell their company. And recent legislation has made these benefits even more generous. So it's now showing up more and more, I have found, in a lot of planning conversations. And so you don't need to memorialize the code here. What matters is knowing when this might be a tool worth exploring, and who can expect a meaningful exit, and what it means for a meaningful exit. Sorry about that. So let's go through. I'll have this little primer thing here. Let's talk about why QSBS is worth even discussion here. So in certain C corporation situations, remember, you got to be a C corporation. If the stock meets a set of rules and it's held long enough, generally 5 years, but recent legislation has provided a 3-year or 4-year hold benefit. Some or all of the owner's gain, it could be anywhere from a low of 10 million, as a minimum of 10 million, to a maximum of 15 million, depending on when the stock is issued, on the sale of that stock, can be excluded from federal income taxation. So in plain English, what this means is that the difference in between writing a very large check to the IRS at closing or keeping those dollars in the owner's pocket. Now, there are some caps and timing rules that will determine how big the exclusion can be per owner. And there's also some advanced strategies, also known as gift stacking, and we'll talk about that in a bit, where the benefit can be spread across multiple family members. The details here are kind of technical, and that's where people like me live. But the big idea for you guys and people listening in is that for founders who expect real growth and a meaningful exit, it's worth asking early whether qualified small business stock is even on the table. So let's talk about the 4 main fundamental requirements for the stock and 1202 QSBS to apply. There are 4 big filters that determine whether this benefit is even possible. The first one is how and when the owner got their shares. Secondly, what's the size of the company and when those shares were issued. And thirdly is whether the company is really an operating business rather than mainly an investment vehicle. And finally, how long the stock was held for sale. So what's useful is knowing that this is not a last minute strategy. If the client might qualify, The planning needs to start years before they think about selling, not after there's been a signed letter of intent. So let's go back and go through these four real quickly. So the first main pillar here, the hurdle here, is that the stock has to be acquired at original issuance. That means that the business owner is buying the stock directly from the company or receiving the shares in exchange for property or services rendered to the company. You cannot get this stock by buying it secondhand from another shareholder. So it has to be original issuance. Secondly, the issuer has to qualify as a qualified small business at the time the stock is issued, which generally looks at the company's gross assets and its status as an eligible C corporation. We'll be diving into that in a few minutes. Next slide, really. Third, the company has to meet an active business requirement, meaning that essentially it's got 80% of its assets have to be used in an active trade or business rather than just sitting in passive investment. So it's got to be an operating, ongoing business. And finally, to unlock the full benefit, the qualified small business stock must generally be held for more than 5 years. Although under OBRA, the One Big Beautiful Bill Act, there is some relaxation of that rule with partial exclusions available at 3 and 4 years for qualifying post-OBRA stock acquired. Let's talk a little bit about the qualified small business requirement. I'm highlighting two of these here. First is the small business requirement on the left. That means that a corporation's aggregate gross assets generally must not exceed $50 million before and immediately after the issuance of the stock. And under the OBRA legislation, the One Big Beautiful Bill Act, that ceiling has been increased to $75 million, thus significantly expanding the universe of companies that can issue qualified small business stock. On the right side, we're going to focus on this active business requirement, where, again, as I stated before, at least 80% of the company's assets, measured by value, must be used in the active conduct of one or more qualified trade or businesses during substantially all the shareholders' holding period. And sometimes I've seen it happen where this test has failed if the company holds too much of certain disfavored assets, like stock and securities of non-subsidiary companies, too much real estate that isn't used in a trade or business, which again can push it into a more active and passive investment posture. So for owners here, the key takeaway is that this QSBS status is not just about how big the company is. It also depends on how the balance sheet is deployed over time. So ongoing monitoring of assets and activities is very critical to get this 1202 benefit. Okay, so what types of entities qualify? What type of activities qualify for this benefit? Well, I can tell you that QSBS favors operating companies that make or distribute things, build things, or deliver scalable services, software, manufacturing, many tech-enabled businesses, and a lot of traditional operating companies. It does not, however, and this is spelled out in the Internal Revenue Code, because these types of entities do not qualify for this treatment. It does not benefit professional service firms where the main asset is the owner or team's personal skills. Think about law firms, accounting firms, consulting firms, medical practices, many financial and hospitality businesses. So a simple rule of thumb here is that the business is product or technology driven. QSBS might be worth asking about. If it's primarily a personal services or financial firm, this particular benefit is much less likely to apply. And by the way, guys, if you have any questions, just ask away. I'll take them as you want to ask them. So I'll stop. You guys have any questions so far? Or are we good to go?
Yeah, Mike, what about like B2B service businesses, like people that do landscaping or,
Yeah.
HVAC, that kind of thing?
Yeah, construction companies qualify. It's more of like the professional, the health, law, engineering, architectural, accounting, consulting, business, stock brokerage, money management, banking, insurance, financing, leasing. Those kinds of businesses are out, but your typical, construction type businesses are fine. They would qualify.
Thank you.
All right. So let's just take a quick example of how this exclusion looks. Very basic. You can see it here. Let's assume you have a business that's valued at $15 million. The assets inside the business have a tax basis of $500,000, and the shareholder has a stock basis in his stock of $500,000. So here you can see on the left side, the tax basis of the assets are $500,000, broken down into three groups: inventory, 0.2 million, equipment, 0.3 million, goodwill, which is an intangible for tax purposes, has zero tax basis. But if we were to apply and allocate the $15 million fair value, then you could see that the inventory is probably worth what it's on the books. The equipment is probably worth more than what it's on the books, because oftentimes equipment is depreciated down to almost zero in a lot of cases. Here, $0.3 million. And then the goodwill is really where all the intangibles lie, and that's where most of the value lies. In this case, it's $10 million. So with that basic fact pattern, let's talk about Mr. A. Mr. A sells his stock. It's qualified small business stock. Let's assume he did form it as a C corporation. He did follow all the rules. He did meet the 5-year holding period. He sells it for $15 million. Okay, well, his stock base is $500,000. He would have a gain of $14.5 million, but he's got that $15 million exclusion. So the entire gain in this case is sheltered by the 1202 exclusion, and he pays zero tax, right? Which is a great result. Now, the other little benefit with QSBS stock is that you can leverage it, or you can stack it, as they call it. And what stacking means is that Mr. A, if he wanted to, could make gifts of his shares to his family members, in this case, his daughter. He gives her a third of his stock, and his daughter basically steps into his shoes. So if he would qualify, his daughter would qualify for the exemption. So now they both sell their shares. Daughter gets 5, he gets 10 million. They both have gains, 9.7 for the dad, 4.8 for her. And of course, that's less than the $15 million exclusion. So no one pays any tax. But meantime, his daughter's got $5 million tax free. And this is a good example, but it gets even more dramatic when you have a business that may be worth $40 million owned by one person, and he may have 2 or 3 kids, and that person will get a $15 million exemption. And if he gives stock to his other 2 children equally, if they now become 1/3 owners, they each will get their own $15 million exclusion, so that the entire $45 million of gain would be entirely tax-free to the entire family. So that's kind of another little ancillary benefit of this QSBS stock. You could leverage it, you can gift it, and the people who receive it also get their own 15 or 10 million, depending on when the stock is issued, benefit. Does that make sense?
I've got
Okay.
a quick question, Mike.
Sure, go ahead.
The gifting of the stock, how would that apply to like the gifting exclusion? Would it go by the basis of the stock that's being gifted, or would it go to the, I guess the valuation of the stock at the time of gifting?
The gift is measured by the fair market value of the stock at the time of gifting.
So
So
in this case here, even though the tax basis is the 0.2 mil for the daughter, that would count as he just gifted 5 million to the daughter anyway?
correct. That's correct. And so he's using up his exemption, his state taxes. He's using some of it up. And some people do this planning, because now if he does it right and he gives it to his daughter, right now, this $5 million is out of his estate. Not only the 5 million he gave away, but any subsequent appreciation on that $5 million is completely outside of his estate.
So if he had gifted earlier when the fair market value was lower, she would still be qualified for, this tax treatment because of the type of stock and entity that it is, and his gifting would have been lower because it was the fair market value at the time of gifting.
Yeah. So this is kind of it's not a great example, because it looks like he made the gift right before he sold the stock, right? So the gift to the daughter is valued at $5 million. Now, you're right, Steve. If for instance, he did this when he formed the company, and the company had very little value, that gift to his daughter may be valued at a very nominal amount. All right. And maybe she gets very little tax basis. Who cares? She now has a $15 million exemption. So when the business is sold, her share of the sale is going to can be offset by up to $15 million of this exemption. So yeah, it's smart to do this if you can see it's smart to do it in advance, no doubt. Good point. So let's talk a little bit about now. We talk about it's great for the seller, right? But you got to look at the other side, right? So now I'm going to take a little peek. Let's take a little peek at what the buyer is going to look, what their perspective is on this qualified small business stock situation. Now, from their point of view, buying stock instead of assets usually means lower tax write-offs in the years after the deal and more exposure to old liabilities, right? When they buy stock, they don't get to write any of it off, like if they bought assets, and they also inherit the liabilities of the company they buy. And so that combination often leads these buyers to say something like, well, if I'm going to buy your stock, I'm going to have to pay less than I would have had to pay if I had an asset deal. So when you start talking to your clients about that, and prospective buyers, don't be surprised when the buyer pushes back for either, listen, I don't want to buy stock, I want to buy assets. And if I can't buy assets and it could be many reasons why an asset sale is not feasible, then there's going to be some math involved in determining what they're willing to pay for the stock, given that they're going to give up a lot of tax write-offs in the future. So in our example before with that $15 million sale, what the buyer, if the buyer's going to buy your stock and has to buy your stock in this case, can't buy assets for many reasons, he's giving up, he or she is giving up a lot of tax write-offs. So in our example, it's about $14.5 million of tax deductions that they won't be able to take over their holding period. So when you quantify that at a 21% corporate tax rate, you're really giving up around $3 million of tax savings over time. And when you discount that back to the present at a 6% discount rate, that roughly works out to be around $1.9 million of lost value for the buyer. Okay. And on top of that, the buyer is now going to be exposed to all the liabilities of the company that they're buying because they're stepping into the existing entity rather than picking specific assets. And when you put these loss benefits and the added risks together, it's easy to see why a buyer is going to come back and say, you know what, I'll pay you $13.1 or $13 million for the stock because I have to factor in my lost tax deductions. Okay. So I see this is what could happen and it usually can happen. And I've heard though, even though if a company really wants your entity, wants to buy your company, they won't worry so much about the tax benefits. They'll pay you whatever it's worth. Some people aren't that in tune to this, but some buyers will say, look, I'm losing all these tax deductions. You got to give me a break. And so this is an example of how that computation could look. So in this case here, that $15 million price would be adjusted downward to $13.1 million in our example. But you may get a buyer saying, look, and it may be possible that they can buy assets. And they say, look, I just want to buy assets. I don't want to buy your stock. I just want to buy assets. And then you may say, well, gee, if the buyer's going to buy my assets and I'm a qualified small business company, I'm not selling my stock. Do I get any of this exemption you just talked to me about? Do I get any of this $10 million or $5 million exemption? And the answer is yes. And let me show you how that works. So what happens there is, and this slide kind of depicts it, is that, yeah, okay, the company, C Corporation, sells their assets for $15 million. They have a $500,000 tax basis. They have a $14.5 million gain. Tax rate is 21%. So they're going to have to shell out $3 million in taxes on that asset sale, leaving them with $12 million net. Then what happens? Company liquidates. The company takes the $12 million and liquidates in exchange for the shareholders' stock. Stock has a basis of $500,000. Shareholder has an $11.5 million gain, but he has that 1202 exclusion of either $10 or $15 million. Here, I'm assuming it's 15, and he pays no tax. So yes, there is a tax on the asset sale, but there's no double tax on the liquidation because it's sheltered by this 1202 exclusion. So in this case, the buyer walks away, seller walks away, excuse me, the buyer walks away with basis step up in all the assets, gets an asset purchase, and the buyer puts $12 million in their pocket. So they can utilize 1202, even if it's an asset sale. So that brings up the question. All right, I understand what you just showed me, Mike. You showed me a qualified small business stock sale where all the gains excluded. You showed me a sale where the stock sale price will be reduced because there's lost tax benefits to the buyer. You showed me a situation where even though the buyer didn't buy the stock, they bought the assets, the owner was still able to use 1202 on the liquidation. And then the question becomes, well, how does this all stack up against what if I was just a pass-through entity or an S corporation or a partnership where I didn't pay corporate tax? I just paid one level of tax on the sale of the company. And so here what I tried to do and summarize is we're selling that same $15 million business under different structures. So if they've operated as a traditional pass-through, S Corp or LLC, and they sell the assets, they pay only one layer of tax at the owner level and keep most, but not all of the price. In this case, it works out to be about $11.4 million. If they qualify, however, for the 1202 QSBS stock exemption and they sell stock and there's no reduction in price because of lost tax benefits by the buyer, they get $15 million. But if the buyer's savvy and says, I need to reduce your price because I'm losing these tax write-offs, they'll get $13.1 million. And if the buyer says, no, I just want to buy your assets, and then you can liquidate your company, your C corporation. Even in that setting, the seller walks away with $12 million. Okay. So, if you're looking at this chart, to me, it seems like, the lesson is that the entity choice that you make can easily move the owner's net proceeds by 7 figures on the same sale. Because I can go as low, it could be as low as $11 million, or it can be as high as $15 million, or $13 million. Okay. So this choice has profound impact on the amount of net proceeds seen at closing. So if you look at only the after-tax proceeds from the sale of a business, it looks like being a C corporation that qualifies for Section 1202 is a winner. But there's another major issue that surfaces that you need to consider before you make that QSBS election. And that is what will be done with the profits every year during the holding period before the sale of the company. And the reason why that's important is that there are different tax rates for C corporation profit distributions and S Corp and LLC profit distributions. And that rate difference favors the S Corp or LLC structure. So the next 2 slides will basically do this. What it's going to show you is how you can calculate when it's worth living with that C corporation friction. In other words, the higher rates on profit distributions in exchange for the QBS or the QSBS tax exemption upside on exit. And I would tell you that if a business has a credible shot at a substantial sale, think eight figures now. Think 8 figures, not 7 figures. 8 figures. The potential savings at exit can be enormous. And in those cases, choosing or converting to a C Corp and aiming for that QSBS exclusion may make sense, even if it means you're somewhat less efficient on taxation on current profits. And then you can use this formula on these slides to kind of calculate the break even. So on the other hand, though, if the outlay outcome is modest growth in the business with a small or uncertain sale, the owner may be better off with a more flexible, tax-efficient pass-through structure and not chasing the QBS at all. So here's this chart is a little more, it's a little more computational, but I can tell you, in essence, what I'm showing you is that profits distributed from an LLC or an S corporation are generally taxed at about 70%. C corporation dividend is going to be taxed at about 40%. So you have a difference of 10 cents per $1 of profit distributions coming out of a S corp versus a C corp. So you have to take that into account, because the advantage of the QSBS savings is the $15 million or $10 million exit exclusion, which at a 23.8% capital gains rate is, in this case, $3.57 million. So that's the benefit if you're a C corp, but you're giving up, you're paying a little bit more money on profit distributions than you were for an S corporation. So what's the break even? Well, if you divide the 3.57 million by the 10%, it's $36 million. So that says that if profit distributions are going to be under $36 million over the term, over the life of the company, then you'd be better off being a C corporation that qualifies for QSBS, because that you won't be, that difference in the profit distribution tax will not exceed the savings on the QSBS gain tax savings. So that's kind of a shorthand approach of figuring out when the break even is. So I leave that to you. You can take a look at it. But yeah, so we went through that. So the planning takeaway here is this. So if the business is really likely to reinvest earnings, grow aggressively, and sell at a meaningful premium, C corporation with this electing this QBS status or qualifying for QBS status may be the better economic bet. But if the business is really a cash flow vehicle that will distribute earnings year after year out to the owners, not accumulating it, not growing substantially, then the LLC or S corporation model often wins, because the current tax efficiency of the distributions taxes can be outweigh the future exclusion that may never really sometimes materialize. So again, just to summarize here real quickly, when does it make sense for a company to elect or qualify or shoot for QSBS status? So it makes sense when you have, again, high growth companies, often software, tech enabled, manufacturing, construction, that are already C corporations, or they're willing to convert to a C corporation, because the exclusion only applies to C corporation stock, not to LLC or S corporation interests. It's especially compelling where there's a realistic chance of an exit above $10 million, since the exclusion can also shelter 10 million or 10 times or up to $15 million of gain per shareholder, subject to the usual caps associated with QSBS stock. The time horizon and capital structure matter as well. You generally need a holding period of at least 5 years to get the full 100% exclusion. And many QSBS type companies expect outside investors who also care about that long-term upside. It also helps that the founder's game plan is to reinvest the profits back into the business and grow it, rather than distribute them out every year, because that's where the C corporation structure and QSBS really shine in comparison to an LLC and S corp. And finally, all the technical requirements still have to be met. You have to stay within the gross asset limits. You got to operate a qualified traded business. You have to satisfy the 80% active test. So this checklist is a starting point, not a substitute for detailed eligibility work. Now, when does it not work? Well, it doesn't work when it's often less compelling in cases where you have, professional service organization, financial businesses. They simply don't qualify under the code for this treatment. They're excluded, and they don't qualify. So even if you tried it, you may be at risk for disqualification. Secondly, even if you do qualify, QSBS is less attractive if you accept substantial annual distributions to the owners. In that case, the pass-through entity tax efficiency on those distributions, where they're only taxed once, may outweigh the QSBS benefit. And similarly, if you think that the exit value is modest, say, I don't know, under $10 million, or if you plan to sell in less than 5 years, there simply may not be enough gain or time for QSBS to deliver a meaningful benefit, especially if you're under the 3, 4, or 5 year holding rule. So, you know, finally, if you're already getting a real payroll tax benefit and cash flow advantages from an S corporation, and you don't expect much appreciation, converting to a C corp, just to choose qualified SBS stock treatment, that can add a lot of complexity and double taxation without any clear payoff. So for these profiles, sticking with a well-structured pass-through entity often resembles or remains the best result. So before I move on from there, any questions on this QSBS analysis? Okay, I take it that no noise, no questions is a signal to move ahead. All right, let's talk about what if you do this whole analysis, maybe at the beginning when the company's being set up, and you think that qualifying for QSBS would be beneficial, but let's assume you're an LLC. Oh, I missed my slide. Let's assume that, as you go back and you talk to your owners about their current tax structure, let's assume that you think now that, hey, this QSBS could be very beneficial to me, but I'm not a C corporation. I'm an LLC and I'm an S corporation right now. Can I still avail myself of the QSBS Section 1202 benefit? Okay. Are you SOL? And the answer is you're not SOL. You can still do it. You can still avail yourself of this QSBS benefit. But when you do enter into a transaction to convert, the only amount that would qualify for the exemption is any appreciation post-conversion. So, for example, if your company you expect it to be worth $15 million, but today it's only worth $3 million. Okay, so you're saying, I still have $12 million of growth there. I'd like to shelter that by the QSBS exclusion. Well, the only amount that would qualify for the QSBS exclusion is the gain, the appreciation from the time you make the conversion, which in this case is $12 million. So the $15 million would not be eligible. It's only the $12 million, which is the post-conversion appreciation. And that conversion from your S corp to an or S corp or partnership to a C corporation that qualifies for QSBS can be done tax-free. Can be done tax-free. So you're not out of luck if you're in an S corp or an LLC situation, and if you can project that more than 5-6 years from now, you expect exponential growth, and this will be a great benefit. You can still get into it. Okay, you could still reorganize, and I'm not going to get into the details as to how that is done, but I know it can be done. You could still reorganize your company to get QSBS treatment. Okay, so I've had people push back and say, well, Mike, what if I hope that happens and I become a C corporation, but you know what? It doesn't, 3 or 4 years from now, it doesn't look realistic anymore. Now I'm stuck. I'm in a C corporation. I'm not going to get this benefit. How do I rectify that? How do I mitigate the result? How do I, do better, get into a more tax efficient structure? And the answer is reelect S status. Okay, you can go back. I think you have to wait 3 years if you were an S corp and now you're a C corp. You have to wait a couple of years, and assuming you wait that 3 years, you can elect back into S corporation status again and get back to where you are. But there is another little trap that you need to be aware of if you go back to S status, and that's something called a built-in gains tax, and we'll cover that shortly. But that's a way of kind of managing that situation if it should happen. All right, so let's assume now you decide that a C corporation is just not the right fit for you, right? It doesn't work for many reasons, for the reasons we just articulated. And the conversation now becomes, especially if it's a new company, should I be an LLC or should I be an S corporation? Okay. And so this slide kind of highlights the key differences between running your business as an LLC versus running it as an S corporation. Now, if you look at the LLC side of the ledger here, you can see that you get a lot of flexibility with an LLC. Profits can be and distributions can be allocated however the operating agreement says so, and not on the other side with an S corporation, not strictly in proportion to ownership. Okay. With an LLC, you can also bring in unlimited number and variety of members. You can have U.S. members, foreign members, corporations, partnerships, even trusts, which makes the LLC a very flexible structure for joint ventures or outside capital. The trade-off, though, here is that under the default taxation rules, if you're an LLC member, the net business income that's allocated to you is generally going to be subject to the dreaded self-employment tax. So you're going to be paying not only income tax, but also the full Social Security and Medicare tax load on all of your share of the flow-through income. Okay. Now, on the S corporation side, the rules are tighter, but the payroll tax outcome is better. So with an S corporation, you have to allocate profits according to stock ownership percentages. There's no special allocations. You can only have one class of stock. You have a hard cap of 100 shareholders who generally must be U.S. individuals. You can have certain trusts or estates, but it's generally U.S. individuals. And in return, the S corporation net income that flows through to the owners is not itself subject to self-employment tax. Instead, the owner operators, they're required to take out a reasonable W-2 wage, which will be subject to payroll and self-employment taxes. But any additional profits can be taken out without the additional Medicare and FICA tax, either 15.3 or 3.8%. So again, broadly speaking here, LLCs win on allocation and ownership flexibilities, while S corporations can win on ongoing payroll tax efficiency if you're willing to live within the eligibility rules and a reasonable compensation framework. A little more difference here. This is some more differences between the two, and that has to do with how LLCs and S corporations deal with appreciated property, refinancing, and new owners. So on the LLC side, again, there's a lot more flexibility. An LLC can refinance appreciated property, distribute out the loan proceeds out to the partners, and so long as everyone has sufficient tax basis, those debt finance distributions can often come out tax-free at the partner level. Also, an LLC can distribute out appreciated property to its partners without triggering immediate gain inside the entity. And also, there's an election that can be made where if a new partner buys in and pays full value for their interest, that new partner can step up the basis of the underlying assets to fair market value for them and just for that. So they get a basis step up when they buy in of the assets. The other thing an LLC could do is also it can issue equity to new partners in ways that can be structured tax-free or tax efficiently through profits interest. But S corporations, by contrast, are much more rigid. If you refinance and distribute cash, those distributions most likely are going to be taxable to the shareholders. Also, if you distribute appreciated property, it's going to cause there to be tax. It's going to be treated as if the corporation sold the asset, triggering corporate level gain, and that gain is going to flow through to the shareholders, and they're going to pay tax on it. And finally, when a new shareholder comes in or inherits their stock or buys stock from someone else, they do not get a basis step up in the assets of the company. So they don't have that inside basis step up tools that a partnership enjoys. So I guess the key takeaway here between, from an LLC versus S corporation discussion here. So I would tell you that probably for a typical operating business that is not real estate heavy, only has a handful of U.S. individual owners and is generating more than about 100 grand of profits each year, an S corporation can be a very attractive structure. You're going to pay yourself, the owner's going to pay themselves a reasonable W-2 salary, which is subject to FICA taxes and payroll taxes. But then any additional profits that come out are not subject to the 3.8% Medicare tax. So you're effectively reducing employment tax on a meaningful slice of that income, which is not the case if you're an LLC. That all that income is generally self-employed income, and it's completely taxable. Now, when would an LLC make sense? Well, an LLC makes sense if you're, and I say it a lot of times, especially when you're running a real estate related business, whether it's residential rentals or commercial rental, commercial properties. An LLC that's taxed as a partnership is usually the superior vehicle. Again, the structure allows you, the owners, the partnership to refinance the appreciated property and distribute the cash out tax-free to the members. It gives you maximum flexibility in the types of investors you can admit, and it allows you to transfer appreciated property or admit new partners with potential inside basis step-ups instead of triggering taxable gain as you would if you were in an S corporation. And on top of that, if you're having rental income is not subject to self-employment tax. So as long as you're not a dealer in real property and you're not providing hotel type services, which means you don't need a S corporation or reasonable salary game. You don't have to play that game anymore. All that income from that rental income activity is not subject to self-employment tax. So I would say, as a practical rule of thumb here, is for scalable service and operating businesses with active owners and healthy profits, S corporation seems to be the right choice. And for real estate related businesses focused on leverage, refinancing, and flexible capital, I would tell you the LLC seems to be the proper choice there. Any questions before I move on? Okay. Let's talk a little bit about IRC section 338H10. Okay. I don't mean to throw code sections at you, but this is important. So let's go back. We went through this discussion about being a C Corp that qualifies for QSBS. If we're not eligible, we looked at it being an S Corp or an LLC. Let's talk about S corporations in particular here, because that's when this section usually comes into play. So let's assume that the seller is an S corporation. Okay. And because of contracts, leases, patents, and regulatory issues, it would be very difficult or impossible for the seller to sell the company's assets. Okay. Very impossible, because they're all tied up in these issues and you can't unwind them, and it's just a mess. And as we know, buyers like to buy assets so they can get a tax basis step up in the assets acquired and then write them off over time. They can't do that if they buy stock. So what happens here when you have this buyer wants to buy assets, seller wants to sell stock? Well, guess what? There is a way for both people to get their desired result. And that way is embedded in this code section 338H10. And it's a tax election. So the buyer can buy the stock, the seller can sell the stock, and the buyer can get a basis step up in the assets. Okay. So there's an example here that I could walk you through, but I think in the interest of time, let's see. So let me do this real quick. So here you'll see a business that has, it's worth $10 million. All right. And our buyer's coming in. And if the buyer were to buy assets, they would allocate the $10 million purchase price to these assets: receivables, inventory, equipment. And then the difference is usually goodwill, going concern value, $4.1 million. All right. So that's what the buyer would like to do if they bought assets. But if they bought stock, they wouldn't be able to write off any of this stuff. The only thing they'd be able to write off if they bought stock is they'd be able to write off the basis that the entity has now in receivables, inventory, and equipment, which totals around $4 million. Okay. So when you work through the math here, I can tell you that when you do and I don't have to bore you with the calculation, but trust me, this is what happens. When the buyer buys the stock and is unable to write up much of those assets, only $4 million of them, their after-tax cost of acquisition is not $10 million. It's really $8.8 million, because they get to write off some of those assets. I think it's $4 million worth of assets And if you assume a 30% tax rate, that's a $1.2 million of savings. So their after-tax cost is $8.8 million. If they bought assets and they were able to write off the entire $10 million at a 30% tax rate, that's a $3 million savings. So their after-tax cost is $7 million. So when you look at the difference here between the after-tax cost of the stock purchase and the asset purchase, and you relate it to the return, the annual income that they're getting. Oh, the difference here is, I'm sorry, is $1.8 million in difference in terms of the after-tax price. But when you relate that to the annual return on that business, it's throwing off $1 million of profit. You can see that the rate of return on a stock purchase is about 11%, and on an asset purchase is 14%. Okay, and that's because the after-tax cost of the asset purchase is less. So buyers really want to buy assets, right? They really like that. So this 338 10 election basically says, which, by the way, the buyer in this case has to be another corporation. All right, the buyer needs to be a corporation, and the seller must be an S corporation here. So they jointly elect to treat the same stock purchase as if it were an asset sale, purely for tax purposes, even though legally it remains a stock transaction. Again, it's kind of a win-win. So what happens tax-wise is that the target is deemed to have sold all of its assets and then liquidated. The seller then recognizes gain at the corporate level, and that gain is passed through and taxed to the S corporation shareholders. So it looks more like a traditional asset sale with only one level of tax. The buyer, however, again, gets a stepped-up basis equal to the purchase price, which drives, for them, larger depreciation and amortization deductions and better after-tax cash flow going forward. And practically, I see this election when the buyer wants an asset sale, economics, especially the basis step-up, but the parties still need the simplicity and legal continuity of a stock sale. And when the incremental tax costs to the seller can also be compensated through a purchase price adjustment. So that's kind of what happens with this 338 H10 election. It basically turns a stock sale into an asset sale for the buyer. Any questions on that? Okay. Hearing none? I went through that already. Okay. All right. The question now becomes, what if the buyer, I said the buyer had to be a corporation for 338 H10 to work. What if the buyer is not a corporation? Well, there is still hope. Not to worry. If the buyer is an LLC or an individual, there is a code section 336E, which can be used to do the same thing. It allows the transaction to be treated, even though it's a stock sale, it could be treated as an asset purchase. So even individuals buying an S corporation stock, buying an S corporation, buying their stock, can get that same asset-like treatment on a purchase. It's 336E that comes into play. Okay, let's get a little more complicated here. What if the buyer is a PE partnership? It's a PE firm. It's not eligible to use H10 because it's not a corporation. And they want to buy your S corporation, an S corporation, and they want to get a basis step up. And the answer is, can they do that? I mean, if they can't use 338 H10, how can they get a basis step up in the assets when they're going to buy stock? Okay, when they're going to buy stock, and the answer is they still can. They still can get that basis step up, even though they're buying stock. Okay, and the reason why that can happen is something called an F-Reorganization. Okay, so what happens there is the PE firm or the buyer is going to request that the selling corporation undergo a tax-free reorganization. It's called an F-Reorg in the code, to convert itself to a single member LLC. And then they can come in and acquire that single member LLC interest, which is then treated as an asset purchase. Yet for state law purposes, it's treated as a stock sale. So it allows for the seller to do that. And it also allows the seller to roll over. If there's rollover equity involved, it also allows the seller to roll over some of their equity into the new entity in a tax-free manner. Okay, so I'm not going to walk through these steps. You could look at it at your leisure. But these are the steps to undergo an F-reorganization to get to that result. And I've also seen this F-reorganization asked for, even if the buyer would qualify for the H10 election. I've seen them insist on the seller undergoing an F-reorg because if you remember, if in order to have a valid H10 election, the S corporation must be a valid S corporation. What do I mean by that? I mean that the election is still valid. It's still valid. It hasn't been inadvertently terminated or it isn't void. And there are so many ways an S corporation can lose its S election inadvertently. Things can happen. It could be impermissible transfers, impermissible shareholders. All kinds of things can trip and destroy an S election. So instead of the buyer trying to do and having to do due diligence to make sure the S election is effective and still good, they bypass that whole exercise by forcing the seller to undergo this F-reorg. And so they buy an interest in a single member LLC, and there's no issue about the continuing vitality of the S election of the old entity. Any questions on that? Okay. Let's go to another issue. Okay, let's assume that you have a company that's a C corporation, can't use qualified SBS, it just doesn't qualify or doesn't want to use it. But they've heard you've talked to them about entity structuring and how it's important to take a look at that. And let's assume they're going to switch to an S corporation because they know that if a buyer comes in and wants to buy their assets, they're going to take a double tax hit when they sell those assets inside that C corporation. So they could switch. I mean, they could switch to an S corporation, but there's a little bit of a tax involved here. There's a little bit of a trap or a toll, I would say. And that toll is something called the built-in gains tax or the big tax. Okay. So what happens here is that they can switch to an S corporation, but they can still be taxed at the old C corporation level when the assets are sold. And then that after-tax gain will be taxed again to the shareholders. They'll be double taxed if that sale of those assets, after they switch, or if the sale takes place within a 5-year window. So what happens is you got to measure this built-in gain at the time you switch, which is the excess. It's the appreciation in the assets at the time of the switching from C to S. And if the assets are sold within a 5-year window, then you're going to pay double tax on the sale of those assets. So as an advisor, if you see a long-standing C corporation with real appreciation and a possible sale on the horizon, that's a signal, I think, to kind of bring in tax counsel rather earlier than later, and trying to kind of plan to switch to the S corporation and have enough time to run the 5-year period on this built-in gains tax. Because once you get over the 5-year period, then you get 100% S corporation treatment on the sale of your assets, which is one level of tax. So it's a good thing to get to, but it takes a little planning, and you got to be aware of this built-in gain tax when you do that switch. And that's just a little bit more on the built-in gains tax for you to take a look at. A couple more topics here as we're running out of time. I want to mention this net investment income tax, or the NIIT tax, as we call it. What is this? Well, this net investment income tax, sometimes it's called the Obamacare tax. It's a 3.8% tax paid on investment income, usually on interest, dividends, and capital gains. Capital gains from the sale of a business too. So people pay this extra 3.8% on the. So in addition to the 20% capital gains income tax rate, there's this 3.8% tax added to the capital gains tax. But just want to point out, for your own informational purposes, right? There is a special rule where an S corporation stock, even if it's sold, and even if it's done with an H10 election, or if the assets are sold as well, the rule is that if the shareholder is active in the business in the year of sale, which usually means they're spending at least 500 hours doing things for and in the business, then that capital gain on the sale of those assets and or the sale of that stock are exempt from that 3.8% Medicare tax. So the takeaway here is that if you have an S corporation that is contemplating a sale in the near future, I would say to survey the shareholders to see if any of them are inactive and think about ways to try to make them more active in the business so they can avoid this additional 3.8%, which, if you do the math, that's $38,000 per $1 million of gain. So that could be a lot for a lot of people. That could be a lot of money. It is a lot of money, but it can be planned around. All right. Last but not least, I saved the best for last. Let's talk about ESOPs and not the fables. This is what is an ESOP? An ESOP is an employee stock ownership plan, right? We all know that. But I could spend hours on this, but I'm going to give you the skinny on them in a few minutes. If you want, the slides can give you a lot more detail, and you can peruse them at your leisure. But here is a kind of a high-level summary of what an ESOP is. So let's start with the basics, right? An ESOP is really nothing more than a qualified retirement plan that primarily invests in the sponsoring company's stock. Think of it as a tax advantage retirement plan that can also function as a built-in buyer for the closely held business. And instead of the employees writing checks to buy the shares, which they don't, the ESOP, the trust, is set up, and the trust becomes a shareholder on behalf of the owners, on behalf of the employees. So a trust is set up, it's a qualified plan, it's the one that acquires the stock from the owner, and it holds the stock on behalf of the employees. And generally, it works. Here's how it generally works in a transaction context. So the ESOP trust buys some or all of the owner's shares at an independently determined fair market value. And in many cases, the ESOP is leveraged, meaning that the ESOP goes out and borrows money, or the company borrows money and loans it to the ESOP. And then those proceeds are used to buy out the owner. And over time, the company then makes tax-deductible contributions to the ESOP, which are then used down to pay that debt, to pay that loan. And as the loan is being repaid, the shares that the ESOP owns are generally released from what is called a suspense account. They're all put initially in a suspense account, but as the debt is being paid down, those shares become released and they're allocated to eligible ESOP employees based on a formula. And that formula usually is tied to compensation and years of service. So let's talk about it from the owner standpoint. So from the owner standpoint, this checks several boxes. First, they get liquidity at fair market value without having to sell to private equity or a strategic buyer who may change the culture, relocate the business, or cut staff. And depending on the structure, you may be able to get significant tax advantage to the seller, to the owner, and the company. And oftentimes the owner can either defer the taxes or avoid the taxes on the sale, or the company can operate totally in a tax-free environment moving forward. And it can be designed that way. So the owner not only gets that, but the owner then can slowly transition out of the business rather than all at once. And so for many founders, this combination of liquidity, control over the transaction, preservation of legacy is hard to match. Now, for the company, the ESOP is very efficient as well. ESOP contributions are generally tax deductible. And in some cases, the company, if it's an S Corp, will no longer be subject to income tax, nor its owners. So it's operating in a totally tax-free environment. And so now it's going to be using all this tax-free money, this pre-tax dollars, to finance the buyout and to fund a broad-based employee benefit. And so these tax benefits can also improve the after-tax cash flow and support reinvestment in the business. They also tend to stabilize the organization. They keep leadership and decision-making local. They also improve retention, and the employees now know they have a real skin in the game. So the employees, it's a great benefit for them, layered on top of whatever else they have. They don't have to put any of their own money in, yet they accumulate shares of ESOP over time, over their careers. And if the company performs well, the account balance will become a meaningful source of long-term wealth. So when the employees leave the company or the ESOP has to repurchase their shares at fair value, and the benefit is paid out over time, over the terms, according to the terms of the plan. Now, from an advisor standpoint, who is a good ESOP candidate? Well, generally, we're talking about privately held companies with consistent profitability, solid cash flow. Solid, I mean 1.5 million or greater of cash flow, a strong balance sheet with a lot of leverage, not a lot of leverage, and a strong second tier management team. And the other key point here too is this: the owner's goals. What are the owner's goals? What are their values? And I've seen it in my case. I've seen it work very well where the owner is okay with getting fair market value for their shares, and that is in contrast to them holding out to get a strategic value for their company, either through a strategic buyer or a private equity firm. This is fair market value, so it's a little bit less than strategic value. And not only that, the owner's okay with that, but they also care about their people. They care about keeping the business intact, not just maximizing the last dollar at the closing table. So those are kind of the goals that you have to kind of talk to the owner about and see if they're on board with that. Because if they are, the ESOP could be a great structure. And also, the business also needs to be large enough to absorb the setup and ongoing administrative costs, and to support this kind of plan. It's an ongoing compliance exercise. You have to have valuations done every year. You generally need audits done every year, and the Department of Labor is looking over your shoulder. So you have to make sure all the I's are dotted and all the T's are crossed. And it can be very complex driven. So you got to be comfortable with that. Okay, so we're wrapping up here, trying to stay on point here. So let's talk about some of the key takeaways from this little presentation. So if you remember nothing else from today, I want you to remember this: encourage your clients to choose and revisit their entity structure with their future exit in mind. So again, like if you have high growth companies that may qualify for QSBS, a C corporation can potentially unlock very large tax savings at sale. If you have real estate and complex ownership situations, assuming that they don't qualify for QSBS, an LLC is often the workhorse for them. For many operating businesses with a handful of active U.S. owners that don't qualify for QSBS, an S corporation can be a powerful tool for managing payroll taxes and planning a sale. And along the way, watch out for C to S conversions that need time to season, because if you want to get to an S corp, you have that 5-year wait period to avoid that built-in gains tax. You also can help your S corporation owners avoid that 3.8% surtax on the sale of their businesses if you plan ahead of time. And also be aware of situations where the ESOP may give the owner both liquidity and a legacy. And so I would say your role is not so much to diagnose all the applicable code sections and the complexities, but to recognize these patterns early and make sure that you bring the right technical team involved and get the right technical team gets involved in time. So, any questions before we wrap up?
No, this was great, Mike. I really appreciate the overview, not only of all of them, but also gives a better grasp of, when we're dealing with these different types of entities and the different, almost like playing fields and environments that they kind of have to deal with.
Good. And I kind of rushed through that because I only have 60 minutes, so I kind of talked a little bit too quickly through it. But
That was a lot.
if you guys have any questions, where you got me, please do not hesitate to contact me. I'd be more than happy to help you. But the other thing I would also point out to you and put this on your radar screen is that our next session is going to be on June 17th, where we're going to talk about transaction tax traps that can reduce the amount of cash the owner gets. So here we're talking about, okay, the owner is selling, they have an LOI, the deal is going to close, it's about to close. And then you have what kinds of transaction tax traps and issues and planning can be done. And we'll talk about that: purchase price allocation, depreciation recapture, personal goodwill strategies, installment sales, earnouts, covenants, consulting agreements, stuff like that, that also can affect the amount of cash an owner walks away with. So with that said, I think we're up against our 1 hour time, and thank you all for attending. And again, I guess the slides will be available and the recording will be available. If you have any questions, feel free to reach out to me. I'll be more than happy to take it.
Thank you.
Thank you so much, Mike.
Appreciate
Bye,
it.
guys.